What is up, everybody? Welcome back to Bitcoin and Markets. My name is Ansel Lindner. CPI drop day. I hope you guys are having a good Wednesday, hump day. CPI came in a little bit hot. We're going to go through it. I haven't read through the actual statement. I did see the numbers came in at 0.4%. So if you're just engaging with my content for the first time, I am on the deflation side of the house. I think we're going to go into a deflationary depression. We're stuck in the end of a giant 75-year credit bubble that is trying to deflate. That means that higher CPI is going to be the odd thing to see. It's going to tend to be lower. And I've called transitory. It has been transitory if you look at the charts. We're just kind of stuck in this 3% range before we really fall into recession is what I'm thinking. But we're going to look at it. We're going to read through it. Glad to have you guys here. Comment down below. I'll look at the comments here in a little bit. Guys on Telegram, comment on the post and I'll look at that. I think I'm going out over Twitter as well. Yes. So I'll look at the tweet and look at the replies to this video and see if anybody's having some comments out there. So let's share the screen and dive right into the BLS. So you guys can find this at bls.gov/CPI. That's where it comes out every single time. And you can see here for today, it came in at 0.4% for March. Shelter and gasoline up. Before we click into this, gasoline, that's kind of obvious to me because I've been noticing down here in Florida, the gasoline prices are going up. I want to say they're about almost getting closer to $4. They were down there under $3 for a little while, and now they're getting closer to $4. I think the Biden administration has been not releasing anything from the Strategic Petroleum Reserve. They've actually been buying recently. So the crude oil price is going up. The gasoline prices are going up a little bit, and that affects everything, right? But let me just put this out there. So if they're restocking the Strategic Petroleum Reserve and they're, putting extra demand out there into the system right now for gas, and then gas affects everything, is that a money printing thing? No. Prices are going up because of some supply issue. Supply side prices are going up. This has nothing to do with the demand side, which is money printing. So that's how I'm looking at these sorts of things. But okay, let's go into the report. And let's dive in. The consumer price index increased 0.4% in March on a seasonally adjusted basis, the same increase as in February. So it did not get hotter. It's not reaccelerating per se. It's just the same as February. And there are some little tweaks in there, but we will cover that. Let's see. Over the last 12 months, all items increased 3.5%. So we're stuck right here in the threes. Index for shelter rose in March, as did the index for gasoline. Combined, these two indices contributed over half of the monthly increase in the index for all items. The energy index rose 1.1% over the month. The food index rose 0.1% in March. The food at home index was unchanged, while the food away from home index rose 0.3%. The index for all items less food and energy rose 0.4%. Now, I like looking at this. I also like looking at CPI less shelter because shelter is a lagging indicator. It will eventually follow, as it did in each of the preceding months. Okay, so all core rose 0.4%. Indexes, which increased in March, include shelter, motor vehicle insurance, medical care, apparel, and personal care. The indices for used cars and trucks, recreation, and new vehicles were among those that decreased over the month. The all items index rose 3.5% for 12 months ending in March, a larger increase than the 3.2% of the 12 months ending in February. The all items less food and energy index rose 3.8% over the last 12 months. The energy index increased 2.1%. Okay, let's look at the table. So gasoline, this is kind of the one we're looking at right here. You can see we went from uh, 3%, 3.8% down to 1%. And we were negative for months before that. This is a deceleration kind of in the rate of increase, but gasoline prices did go higher. All energy went from 2.3 to 1.1. So that is also a decrease in the rate of change coming off of some negative readings. So, if this pattern is to persist to the next one, this would turn into a negative number for energy going into the April reading. Shelter. Before I do that, let me double check. Got a sinking feeling that I was not. Yes, I'm unmuted on Telegram. Okay, so back to shelter. We have 0.4%. Now that is unchanged month over month. And in there, they said it increased. But remember, the way they do the weighting is shelter is about a third of the entire monthly reading. And if half of the entire headline reading, and if half of the increase is coming from shelter, and it's somewhat constant here, 0.4, 0.4, 0.6, then 0.4, 0.4. Yeah, if that continues or maybe decreases a little bit, that's what I'm expecting throughout the rest of the year. I am still expecting a recession throughout the rest, before the end of the year, the start of a recession. Of course, labeling something as a recession is always backwards looking because they need 2 quarters of negative GDP growth plus some things with like employment and other things. So the actual recession might not be declared until into 2025, but we will be starting recession this year. And I do think that Powell will be cutting rates as well this year. Okay, so that's the report. Let's look and see what the markets thought of it. Bitcoin didn't really like it. We looked at this on Monday. So Monday, the price was going up here when I was doing the fundamentals report and live stream. And I said, this doesn't really feel very strong. And of course, that was a fake out. We are back now independent, and we're below this important close back here from March 4th. That's kind of defined this entire period, weaving up and down through this important level from March 4th. 50-day moving average is also coming up, supporting the bottom of this pennant, which is very interesting. So I think we probably will get a test of that. That means we're going down to 66,000, maybe even testing into 65 before we bounce higher. So Bitcoin did not like this one bit. Let's go down to the 5-minute and see what we're dealing with here and get rid of the 50 period at this time frame. So you can see we were tracking sideways, then the CPI hit and it dipped down here about almost $1,500 dip. This is nothing in Bitcoin land, and we were expecting consolidation moving into the halving. So really there is nothing significant to get your heart rate going here on Bitcoin. It just, it's kind of, a lot of people don't like this because they were predicting 100,000 by the halving. They were predicting all of these huge blow off top numbers because of the ETFs sucking up all of the Bitcoin, Mr. 100 sucking up all the Bitcoin. Now we have a new company out there that's following in the footsteps of MicroStrategy. They're called MetaPlanet. They're trading in Tokyo. They're a Japanese company, and they are kind of following in the footsteps of MicroStrategy. So there's a whole new source of Bitcoin demand and Bitcoin buying. We also have the Hong Kong spot ETFs are coming online. So, people having all those things, they were like, how could the price possibly not go up? It doesn't make any sense. Well, I've been saying we need consolidation because we went too far too fast. So let me go to log, reset this, and bring up the RSI. And you can see the RSI is doing some nice cooling off. It will be nice to see if this could hit 70 and be completely cooled off, because see back here, we were up here at 83. It was a little bit too hot. We go through into the ETF approval. some more consolidation here, and this RSI gets down to into below 70. That gives us room and fuel to make the next move higher. Now, this one topped out at, uh, let's see, where was this? I got to turn on the numbers here. 88, which is extremely high for weekly RSI. We did have a bearish divergence going here, higher high on the price and lower high on the RSI. On the weekly time frame, this is very powerful. This also happened, if I zoom out, back here in July of 2019, there was also a weekly, very slight, but there was one, a weekly bearish divergence at the time. And I remember talking about this. Our community was on Discord at the time, but I remember spotting this and saying, "Hey, this is going to be a powerful bearish divergence." And yeah, price stagnated for many, many months after that. I don't think that's what's going to happen this time, but I'm just pointing out that a bearish divergence on the weekly is actually a pretty significant thing. So that's what I'm looking at for the Bitcoin price. Let's go to the other one, S&P 500. Go to the daily. And this is futures. So they are trading. The actual, well, let's see, actual market just opened at 9:30. We see a big gap lower. There is some, I mean, if it breaks this level right here this is from April 4th close, that would be probably letting the S&P 500, come down and test some support at lower levels. Still in the ballpark of my projection line here. This was kind of just a wag, but what it symbolized was a pre-recession period. The economy is deteriorating, yet people have money to put into more safe havens. And the S&P 500, since it is a narrow index, and fewer and fewer companies are getting the majority of passive flows. They're getting the majority of safe haven bids. Like, hey, I'm not going to buy this new car right now. I'm actually going to add to my retirement savings. And what does that do? It goes in percentage based into like a S&P 500 index, or however you have it set up. So disproportionately, the largest cap companies will benefit. That's why FANGs do so well, or the Magnificent Seven, whatever they're calling them now. But this is kind of what I was expecting throughout the year. Put this line back on here back at the end of 2023, and we have been pretty darn close to that. This was going to top around the middle of the year. I just have it on May here, and then going into recession. This was my pre-recession sliding into recession call, and then a recession by the last quarter of the year. We will see how this progresses from the S&P 500. Okay, another one I wanted to take a look at was actually, before we get to the 10-year, let's go to DXY, and it is also making a move here. Big up day, almost 1% higher, 75 basis points higher. The dollar is getting stronger, and one reason for that is this is the Japanese yen, and you can see it's been battling with this level for a long period of time. That is 152 yen per dollar, roughly. Tried to break it back here last November, got right up to it for the last month, and finally this morning we're breaking out, or the yen is, this would be inverse. So the yen is falling versus the dollar. It takes more yen to buy $1. This is significant. Japanese yen is a huge global currency, and it's very tightly correlated with the Chinese yuan. So let's go there, and you can see, well, let's see, what did I have? Was that the 50-day? Yeah. Okay. So this is a 50-day moving average on here. You can see that it tested it. It was holding it. Then it broke down below. Now it's back above, kind of being held up by the 50-day moving average here. And there is also the same similar pattern. If you flip back and forth between the Japanese yen, the last month it's been pushing up against this level and it's breaking out, going back to the Chinese yuan. same sort of deal. It was pushing up on this level, and we will see if it breaks out. It probably will follow the way that the yen is going. So that's why the dollar is strengthening. We can look at the broad dollar index. This includes the Chinese yuan. It bounced off the 50-day moving average, and it is going higher. This is delayed, I believe, because it's from the Federal Reserve. So I think it's an end of day thing. By the end of the day, when it gets updated, we should see it breaking some of these highs and going a little bit higher here on the broad dollar. Back to the DXY. Big day for the DXY. Okay, now to the US 10-year. This is the one that's kind of invalidating a recession call to me. And that is because for recessions, they can be caused by higher interest rates because it will stress the economy, stress the banking system. But it doesn't stress the actual investors and stuff, because higher yields are income. That's income for people. The people that own the treasuries, money market funds, people that put their money into a money market fund. I know a couple people in our community said they were moving money out of their savings account or whatever and putting it into a money market fund and getting that 5%. I don't think they're paying that still. I think it might be down to 4%, but this is a big opportunity that counts as income for people. In the economy, this is income. So as the interest rates are going up, it's actually quite bullish for the economy. It means people's incomes are rising, investment incomes at least. So for a recession to happen, we need to have falling interest rates, naturally falling interest rates. And that's not the Fed coming in and cutting rates. Okay, before a recession happens, we will have falling interest rates. We are still off of this top formed back in October. We can just take a measure from the top. We're still 10% off of the top. So we have a long way to go for this. That would be a big pain trade for the banks. Remember, I was expecting a end of Q1 kind of banking crunch. What is Jeff Schneider calls them, a bottleneck. So end of Q1 bottleneck for the banking system. It might be late. I mean, we're still in this general window of 2 weeks prior or 2 weeks post the end of quarter that we could see rising interest rates start squeezing the banks. It won't be squeezing the general economy, but it'll be squeezing the banks. And that's a bad thing, obviously, because the financial system is what we're worried about here. Anyway, so that is the US 10-year. Let's just go back to Bitcoin. All right. And what do we have next? Let's go to the Fed meeting calendar. So a lot of people are talking about the Fed is not going to cut rates because of this. CPI is still overheated. It looks like it might be reaccelerating to a lot of people. And so the Fed is not going to be cutting rates because that would be quote unquote inflationary. I don't think so. They have a ton of time left here. So they have the next meeting is coming up at the end of this month. They will be releasing that on 1 May. Then they have the June meeting, July meeting, September meeting, November and December. So they have 6 meetings to cut 3 times. They can also cut more than once at a specific meeting. So if we get to September, which is the end of Q3 bottleneck, and the economy looks bad, Powell can decide to cut 75 basis points or 50 basis points, whatever. He doesn't have to cut by 25 each time. But if you think he's going to cut by 25 each time, yes, they're running out of meetings to do that, especially if they don't do that here in April. That means June, they're going to have 5 meetings to cut 3 times. Yeah, that would be pretty fast. But if September, they have an oh shit moment, or even in December, they have some sort of oh shit moment, which I think they are expecting to a degree. Okay. Like I was saying in the pre-show on Telegram, you don't have the all other major economies, Japan, China, UK, Germany, in recession, and the US avoids it. And I hate to say it, but the administration has been um, spending a lot, which I think is keeping the US from tipping over like all the other countries. But that doesn't end up working in the long run, right? Even in the medium term, you can't avoid that type of thing because the banks will, the banks will start feeling the pressure, and then they will kick off a financial crisis. So um, that's kind of where we're at with the calendar. I don't know exactly when to expect the first cut, June or July. Perhaps we get 25 in July and then 50 in September, something like that. But I do think they will still get their 3 cuts in this year, mainly because, as I was saying earlier, if the rise is due to a lot, gasoline, yes, that causes prices to go up, but that's not a money printing problem. Why would you address a supply crunch with uh, monetary policy? You should address a supply crunch with physical policy, with going out there, maybe trying to help the market, more specifically pinpointed responses. It doesn't make any sense to, like when COVID came around, it did not make any sense to address the supply chain disaster that was COVID-19 with monetary policy. It was a supply chain issue. You don't fix a supply chain issue by easing or by pumping stimulus out there. You actually make it worse. And that's exactly what they did. So diagnosing the cause for price increases is very, very important. It's not a semantic issue. It's actually a diagnostic issue that will allow you to know what's best for the economy, or what to expect, at least, from the economy, what to expect from the effects of policy decisions. So if you know that the prices are going up because of supply chain, and then they send out a bunch of stimmies, you can use that information, correctly diagnose the situation, and you can say, well, prices are going to go higher because of what's going on, not because of money printing. And it's going to be transitory, it's going to be temporary. If you thought it was due to money printing, you would not have thought it was going to come down off of 9% CPI year over year. You would thought it would be 15, 20% by now. But if you use or if you have the proper diagnosis, you can say, oh, it's going to be transitory, just like we have done here. Okay, and last thing, before I check the comments. So if you guys are watching on YouTube or Rumble, make the comments down below. You'll find links down below to all of my places that I'm at. Telegram, put the comments in the post for the live stream, and Twitter. I don't know exactly where to find the comments for Twitter, but I'll look around, see if I can find them. Okay, this is the 5-year break even in blue and the 10-year break even in red. Now we can have inversions in this. This is, if we read this, break-even inflation rates represent a measure of expected inflation derived from the 5-year Treasury and the 5-year Treasury tips, or inflation indexed constant maturity securities. So inflation adjusted. This is the difference. So break-even is the difference between the rate of the 5-year and the rate of the 5-year inflation adjusted. That gives you an expectation, a market expectation of 5-year inflation and 10-year average inflation. Okay. So normally you would expect more inflation to be happening in a 10-year window than in a 5-year window, right? So you should expect the 10-year to be above the 5-year. You can see that here going into COVID, the 10-year was above the 5-year. We went down 10 years, still above the 5-year. Oh, and then here, actually January of 2021, we got the inversion, and that was inverted. It's very similar to a yield curve inversion that is signaling near-term near-term concern, okay, but long-term not as much concern. This is the inversion. It got really significant here in March of last year when we had the banking crisis. And then it kind of went back and forth, got uninverted here a little bit, uninverted here coming into August of last year. And now we are inverted once again. Let me zoom into this most recent time. So you can see we were uninverted here last year. And now just recently, starting in February, we have now become inverted again, which is signaling bad. The market is thinking there is a recession coming. All right. And also, look at this. The break evens, they're both around 2.3 or 2.4% long run inflation, which is around that 2% goal from the Federal Reserve. Okay. That's going to do it. Let me take a look at the comments. See what we got here. John Delaney, what's up, man? Good to see you. Good to see you here. Hope I was clear on all of my stuff for inflation. Okay, we got some comments here. Politicians are not concerned with actually solving problems. Their priorities are as follows: stay elected, personal enrichment. Yeah, Peter, I agree. I totally agree with that. Well, actually, right now, their main priority is to keep Trump from getting elected. So yeah, they have to get Biden reelected to keep Trump from being elected. And yeah, that is their main priority. I hate to say it, but they have, I think, kind of stumbled into some smart policy. And that is the initial release of the SPR, I think, worked out well for them. Right now, they're plussing up the SPR so they can dump it later closer to the election. So that alone tells you there's going to be some downward pressure on gasoline prices and CPI as we go into that. Actually, which screen am I sharing? I'm sharing that one. I'm going to share my website here while we're answering some questions. BitcoinMarkets.com. Check it out. Support the show. So yeah, the SPR is being refilled just so they can dump it later around the election to try to get Biden reelected. I don't know how they can put that guy. It's like elder abuse at this point. You know, he can barely say a sentence. And he walks. I don't know if you guys have been around older folks like grandparents, great grandparents, and when they start getting real robotic in their walking, they're very unsure. Their arms are, kind of locked at a 90-degree angle, and they're walking. That is a sign of that he's not fit for office. So I think that they're going to try to get him elected. And that is what this SPR stuff is. And again, CPI will be tied into gas prices. And that is another thing that will make it come down throughout the rest of the year, not just the economy. So, all right, that's the only one I'm seeing from Telegram. Let me go to Twitter and see what we got going on. No comments I can see from Twitter. So that's going to be it, guys. Thank you for joining me. Hope you have a great rest of your day, and I'll see you guys